Max Keiser. This is the Keiser Report. Oh my God, I just had a revelation. I'm probing the deepest recesses of my unconscious. Wait a minute. Stacy?
Hey, Max. You know what? I'm glad to see that you have a little whiteboard here because we might need it because this whole episode is going to be, well, this first half of this episode is going to be about charts because the Wall Street Journal did a great, basically, assembly of charts to show where we are 10 years after the financial crisis hit. Remember the financial crisis of 2008? Well, 10 years later, 2018, these are some where we've come from since then. And first, they start with good times are back in the market. The government pumped trillions of dollars into the economy to stabilize the banking system. Bank stocks lagged behind the market, but got a boost after November 2016 when Donald Trump was elected president and promised to tear up crisis-era regulations. So this is the Dow Jones Industrial Average up there on the white, and these are the banking stocks, which kind of lagged for a while because everybody thought, well, you know, the Dodd-Frank was supposedly going to do something and all these sort of regulations that were brought in to keep them from defrauding the American people. But Donald Trump came in and the Republicans are promising to tear up everything.
Well, the number that they look at to determine whether or not they're succeeding as politicians is the Dow Jones Industrial Average. So if that's going up, they consider themselves to be succeeding. The underlying fault of this mechanism to distribute the wealth generated by the country is never considered. The fact that the wealth and income gap is spreading wildly toward third world status, infant mortality up, and healthcare bankrupting millions is not part of the equation. They simply look at the Dow Jones index to determine.
Mortality rates are not only up for infants, but also for working age adults. So that is a shock. That is something that hasn't really happened in the U.S.
Right. The opiate drug makers are in the Dow Jones. So that goes up.
No, they're actually the biggest opioid is a family-owned private business, the one in Connecticut that makes Oxy and all those things. They're actually not in the Dow Jones.
Right. And all the ancillary businesses that support the heroin, synthetic heroin distribution. They distribute heroin instead of wealth. That's the American economy. I mean, back in Soviet days, they ran on vodka. In America today, it runs on synthetic heroin.
So we have two more charts here showing this inequality. The Wall Street Journal does show the two charts that establish that indeed there has been huge inequality. I remember 2008 was when Obama came into office. He exited in 2016. So these are mostly his 10 years. This is what happened under Barack Obama. I remember a lot of the resistance media says that this was a great, great, great time. But as the actual data suggests, why the mortality rates increased so hugely that the World Health Organization sort of bodies say this is only happens in sort of like civil war or in epidemics that we see increases in mortality of the amount that has happened in the United States. Well, let's look at these next two charts. The first one, median household income is only up 5.3% since 2008. Employment has risen, but about a fifth of the U.S. jobs are in occupations where the median income is below the federal poverty line. And median household income is barely above its 2008 level, adjusting for inflation. So as we said, like most of the very wealthy receive more income from dividends and interest income and capital gains. So they're still on their lower income. The stock market is up 3, 4, 5 folds since 2008. That's where their income comes from. People working for a living, well, 20% of people in a job are being paid less than the federal poverty level.
How do you keep these people from revolting? Push the synthetic heroin, push the opiates. I mean, I don't think there's any coincidence that you've got wealth concentration unprecedented and even more extreme than the robber barons and a very docile population and an explosion in synthetic heroin being pushed by the pharmaceutical industry and the medical insurance industry. There's no coincidence there. America's strung out. They're nodding out. They're dopers.
According to these charts from the Wall Street Journal, it would suggest that there is an epidemic of inequality And in a complex system, one doesn't know how it's going to manifest itself.
Look, you've seen those videos in San Francisco in the BART, the public transport station, of people openly shooting smack right there in the public and defecating on themselves. And you know, people look at that and say, that's the American economy succeeding. The stocks that push this are going up. Okay? And as you know, I hate to be harsh, but let's be real. I'm going to say something that people say, oh, that's very harsh. But it's true. No, I'm not going to say it.
Okay. So we're going to move to the next chart from the Wall Street Journal, and this shows the income gap, the wealth and income gap, 2008 versus 2018. Inequality has grown. People at the bottom of the pay scale lost their jobs during the crisis. The government's response to the crisis helped inflate the value of assets like stocks and real estate, which are more often owned by the wealthy. So here you have a distribution of wealth by wealth percentile, 2007 versus 2016. So this is under Obama's watch, and the resistance wants us to return to this. They don't want to fix this. The resistance heroes, the Rachel Maddows of the world, want this to continue like this because she's at the top. She's earning a lot more. So in fact, the top 1% owned 33.7% of all wealth in the U.S. in 2007. Now they own 38.7%. So their real wealth has increased by over 10%. They're happy. Well, the rest, the next 9% owned 37.7%. In 2016, it's 38.5%, so a little bit better. But the bottom 90% owned 28.6% of U.S. wealth in 2007. 28.6%. Now it's 22.8%. That's down. That's down like almost 20%. So they've suffered a huge crushing defeat, the bottom 90%, under a system that Rachel Maddow, MSNBC, thinks was fantastic. They think that system was so freaking great. And who voted against this? Who voted against this? It can't be us. It can't be me, Rachel Maddow, and this system I love that has done so well for me. It must be some foreigners. It must be some Superman. It must be some uber freak from out of space.
I see where you're going with that.
Yeah.
You know, they're trying to push the blame somewhere else instead of on the underlying system, which is statistically and
this is the data. These are the facts. This is coming from your own Federal Reserve. This is coming from your Bureau of Labor Statistics. This is coming from U.S. government data. It shows that the top 1% are over 10% better off. The bottom 90% are more than 20% worse off. So
by design, by engineering, by financial engineering, it's called.
Occam's razor would suggest this is a reason people didn't want the continuation of the Obama regime. Remember, Hillary Clinton ran as a continuation of Obama, even though she was way further right than him. But she ran as a continuation of Obama, and people were like, well, I'd rather just blow the whole system up with an orangutan. I don't care.
Well, look, I mean, there is the fake left in the media space, like Rachel Maddow, but equally culpable are journalists, so-called, on the fake right, like John Stossel, who's a fake right-wing journalist, who also doesn't focus on any of the realities that we are describing here. And, on the old failed dictatorships, regimes of yesteryear, as the economies were failing, they would prop up bigger and bigger statues of their dictators. And so here in America, as the American economy is failing miserably, they're propping up their icons of these, S&P 500, or these few stocks that represent, the totemic, godsends that we should all worship before, even though they're being puffed up by free money from the Fed.
Well, exactly.
It's a Potemkin village, essentially.
Okay. Have you ever once seen Rachel Maddow leave New York City, leave Manhattan? No, she records there all the time. She hangs out with these people who have convinced themselves, because nobody likes to pretend that they've become wealthy in a rigged game, that they've been the beneficiaries of free money, because they believe they've internalized this notion that, well, it's just going to trickle down because I'm so benevolent. I tip the waiter quite well. I give 30-40% tips. I'm a good person, and this is just trickling down. So the next chart from Wall Street Journal. For the bailouts, many unhappy returns. The financial crisis cost the U.S. economy some $6 trillion to $14 trillion in lost output and ended only after the government promised aid worth an estimated $12.6 trillion. Yet many were dissatisfied with aspects of the response, ranging from the price tag to the perceived choice of beneficiaries. You see how the Wall Street Journal, of course, has to, because they are the Wall Street Journal. They're not going to outright say, well, it's perceived that all the money went to Wall Street. It did, okay? Their losses were made up. The bottom 90%, they're clearly, as the previous chart shows, their losses, they had to eat their losses. They had to pound sand.
Right. Well, no time in history during a crisis like in 2008 where the creditors bailed out instead of the debtors. I mean, going back even to biblical times, it's the debtors that get bailed out, not the creditors. But because of the fascism, the neo-fascism, the Mussolini-like neo-fascism between bankers on Wall Street and the federal government fused together in a corporocratic daisy chain of incest and bile and financial shenanigans, the creditors were bailed out. And what do they do with all that bailed out money? They inflated the bubble even higher. So now we've got S&P hitting the new all-time highs, but the morality and the ethics of the country and the wealth and income gap have nosedived. So you've got people in the street shooting up heroin, defecating on themselves, and like Janet Yellen, whoever's running the Fed these days, Jesse Powell, walking by and saying, that's a indication of our success. My kids are there shooting up heroin and defecating in the street, Jesse Powell will say, because I'm a hero in America. Thank you, Jesse Powell.
You know, this last chart is going to show exactly and demonstrate the truth of what you've just said, because it says government-backed firms make up 96% of mortgage security issuance. So U.S. housing policy is frozen in time. When Fannie Mae and Freddie Mac were bailed out in 2008, lawmakers promised a reset of U.S. housing finance. But 10 years later, next to nothing has changed. So government-backed firms, 96% of all mortgages are backed by the U.S. government, the taxpayer. And you know why? Remember the 2008 financial crisis. What was it caused by? Wall Street reaping huge amounts of fees and profits for themselves when they spun all these subprime mortgages into CDOs and other mortgage-backed securities, and they profited hugely. They all went bust. They got caught holding some of these dodgy products, and they got bailed out.
They themselves call them,
Yes, I know. Goldman Sachs famously in the testimony.
Right, so what do we do? I mean, what do we do when we have fake journalists on the left like Rachel Maddow, fake journalists on the right like John Stossel, and there's no coverage for Americans to understand?
You tune into Keiser Report.
Yeah, of course. And we're going to be live in New York coming up.
Yeah, right down near Wall Street, actually.
Right.
Like right there next to Wall Street. We're going to be doing some live shows. We're going to do a few live shows next week in New York.
New York City. We'll be there and say stuff that, I don't even know what I'm going to say. Well, stay tuned for the second half. Much more coming your way. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Chicago and talk with Mish Shedlock of MishTalk.com. Mish, welcome back.
A pleasure to be back on the show, Max. How are you doing?
Well, super. So, Mish, the latest jobs report, either 164,000 jobs were added or 3,000 were. The unemployment rate allegedly fell to under 4%, the first time since 2000. Okay, your thoughts on the jobs report, Mish?
Well, when we look at wage growth, everyone keeps expecting wage growth, and people keep talking about the Phillips curve. You know, and I know the Phillips curve is dead, yet people just cannot give up on this idea. Wage growth is anemic. Last night I was up to like 3 o'clock in the morning. I put out a report. So, okay, Max, where are the jobs? Where are we creating these jobs? And what are they paying? Most of these jobs, except for professional and business services, are either stagnant or manufacturing has actually been declining since 2000, or actually been declining for decades. So I looked at two big groups, retail trade and leisure and hospitality. That's people working in bars and cheap restaurants and the like. That's where the wage growth has been, Max. And excuse me, that's where the job growth has been. Wage growth, non-existent. Were it not for professional and business services, Max, the whole picture would be an absolute disaster. Mining, utilities, those are two of the big ones. No job growth in those, Max, none.
Right. So as labor productivity continues to rise, hourly compensation continues to fall, right? Talk about that a little bit.
Now, the BLS only comes out with these real wage reports every May. So, and it's for a year and a half ago. So we're going on 2 years old here now. But the last stats I had, Max, was that real wages, that's inflation adjusted wages, are down in 7 out of the last 11 years. And people keep expecting millennials to go out and buy houses when home prices, which aren't even in the CPA, keep rising and rising and rising. Real wages are declining, and economists can't figure out why people aren't buying homes. Well, they can't afford them.
Presumably, it's dangerous to the stability of this consumer economy and political system, right? Is there a so-called cohesion risk, as the economist likes to call it, Mish?
Well, there's so many risks here, and I keep reading stupider and stupider things. Right before we came on, France came out and said, their budget director said he's looking to balance the budget. Well, you know, and I know that ain't going to happen. However, the economic commentary on it was that it was insane. So I'm sitting here thinking, in this world of Keynesianism and MMT and free government spending and money grows on trees, we've now come to the point where allegedly it's insane to talk about balancing the budget. That's where we are. And yet, despite this, what governments are doing in Japan, in Europe, in the United States, the CPI, at least as they measure it, of course, they don't put asset prices in there, most definitely homes or the stock market, prices are barely rising. Again, if you believe them, and in a lot of ways I do, because they don't measure what's important. They don't measure the cost of education. Healthcare is underreported in the CPI, and home prices aren't in the CPI at all. So, of course, the way they measure it, they say that inflation is benign. It's really not. And millennials, the screwed generation, are really getting screwed on this.
As you say, wages are either not keeping pace or declining. Rents, however, are surging. This has been going on for a while. Can you talk about this a little bit?
I follow a report on the Rent Cafe. They publish these stats. We're seeing the biggest year-over-year increases in rents in quite a while. Of course, it's all over the map. Now, I emailed them and asked them, I said, I wanted to know if this was weighted averages, and they said yes. Some cities are soaring. And, where is that? Of course, it's near where they refine oil. Some places in Texas were seeing rents up as much as 32% in a year. Wow. That's tied to oil. In other places, namely, New York City, where people are fleeing, actually. People are fleeing Illinois as well. So we're seeing declining rents. This is another one of the fallacies, though, that the BLS takes all of these things, puts them in a mixer, averages them out, and says, aha, this is what's happening. Well, CPI is really an individual thing. If you're going to college, your CPI is way higher. If you're paying for your own health care, your CPI is way higher. If you're on Medicare, and I'm going to be on Medicare in September, Max, there's a plus and a minus to that. The minus, of course, is I'm getting old. The plus is I'm getting nearly free health care. All of that figures in, and they say, well, let's average this out. And with people getting older and older and going on Medicare, who's paying for this? Well, it's the young, healthy workers that are screwed. They can't afford a house. Essentially, they're paying by Medicare for me. Makes no sense, Max.
Let's look at some of the bigger economic trends out there, and let's look a little bit at gold. We've been talking about gold for a number of years and watching it ebb and flow with different scenarios. Now, the demand in Q1 has slumped to a 10-year low. The previous low was the Q1 of 2008, which was then turned out to be a big springboard. We know what happened later that year. So your thoughts on gold, Mish, and the dollar?
Well, that was the headline, Max. The headline was gold demand slumps to the most in 10 years. That's a blatant fallacy. You know it, and I know it. And how do we know it? We know it by looking at the price. The price is not at a 10-year low here, Max. And all these analysts, they look at jewelry demand, they look at demand for coins, and it's the demand for coins from the retail investor was what they were talking about. That demand is at a 10-year low, assuming the report is accurate. I have no reason to believe that it's not. People are actually selling their coins there now to invest in stocks. I mean, personally, I think that's crazy, but that's what's going on, or at least that's what the report says is going on. But that's not the demand for gold. Every ounce of gold, nearly every ounce of gold that's ever been mined since inception is still in existence. That is part of the gold supply. Yet gold prices up $300 off the bottom a few years ago. That's the real demand. The real demand is what is all the people holding gold. They could sell it, but they're not. They choose to hold it at a price $300 off of the bottom. And with retail investors selling their coins to buy stocks or maybe just to pay bills, Max, actually, likely that's what I think is happening because consumers are tapped out. That's the demand for gold. So these analysts are wrong. And the retail investors selling their gold coins, that's a contrarian indicator, if you ask me. Max, I think this is a really nice time here to buy gold when people are tossing it away, when retail investors don't understand what's going on, or they're tapped out and they need to sell their gold to pay the bills.
Right. Well, yeah. And then on the dollar, the dollar is always talked about in the same sentence as gold. These two have a kind of a symbiotic relationship. The dollar's been rallying recently. So how does that factor into it, Mish?
Well, the dollar's been rallying. Gold has actually held its own. It's been drifting every time the price in the last, actually for 2 years now, it's in a 2-year consolidation pattern here, right around $1,300 an ounce. Every time it's trying to break out above that 50 level, it's been turned back. And every time people, it falls back, we see the talk from economists, well, it's going to crash, it's going to drop to 500 or 800 or whatever. I like my chances here. The U.S. deficit is going up. In Europe, I think they're at the end of the recovery. There's foreign currencies that are really under pressure here right now. And of course, no one believes any of the stats out of China. I think the global economy has peaked here. I've said that before. Wrong. You got to admit your own mistakes. But here we are. It looks like it again, and very few see it coming. The Fed thinks the risks are skewed to the upside. In the Eurozone, we've had really bad economic reports out of Germany for about the last half year now. So how is that going to work? I think Germany's not going to be an engine of growth. And we have Trump firing off trade wars with about everybody. Max, no one wins trade wars. It might raise prices, and that's kind of what we've seen here. Oil prices are going up on this talk. The last time oil was surging like this was 2008. Oil then hit 140. The next thing we knew, the U.S. was in recession. Max, I think we're heading up for a replay of that. If so, what's the Fed going to do? I think we know what they're going to do. They're going to cut rates. They're probably going to panic if we hit another recession. I think that's going to be good for gold. Ultimately, gold is a measure of faith in central banks, and that's really what topped a few years ago when gold bottomed. Mario Draghi came out in 2012, and he said, we will do whatever it takes to save the euro, and believe me, it'll be enough. The irony of that statement, Max, was he didn't do anything. They did nothing. That statement alone, however, restored confidence in central banks for a while. People are now questioning faith in central banks. People are wondering in the U.S. whether or not the Fed's behind the curve. The ECB has made no progress at all in its battle to produce inflation, yet we've blown these asset bubbles. And the quote of the day, or quote of the month, came out of a report the other day. That just hit me because it was synonymous of what I've been saying, and it's if they wanted to cause deflation, the central banks would do exactly what they've been doing for the last 6 years. Building these asset bubbles, when they burst, it's going to cause deflation.
All right, Mish. Well, we got our cutter off there. Of course, another benefit of being near Social Security age is you've got tremendous wisdom. We appreciate bringing it to the show. Thanks for being on the Keiser Report.
Max, always a pleasure. We need to do this more often, and we'll see you next time.